SCHD is one of the most polarizing ETFs in the market today. Some investors think it's one of the best long-term dividend investments ever created. Others think there are better options, especially after watching AI stocks and technology names dominate the market for much of the past 12 months. But what if that is the exact reason investors should be paying more attention right now? And in today's video, we're going to be answering one of those questions. Is it finally time to buy SCHD heavily in this world of AI, or should we look elsewhere? The market today is obsessed with artificial intelligence, technology stocks, high growth companies, and honestly, for good reason. I have a lot of my top investments in those very areas. Many of those companies have delivered incredible returns, some life-changing returns. But while investors have been chasing growth, SCHD has actually quietly fallen under the radar. That's interesting because some of the best investments are often found where enthusiasm is the lowest. So let's take a look at SCHD and what they actually offer, and whether today's environment could create an attractive buying opportunity for you and your portfolio. And let me be clear, you do not need to be a so-called dividend investor to invest in SCHD. SCHD tracks a portfolio of high-quality dividend-paying companies. But unlike many dividend ETFs, SCHD isn't simply chasing the highest yield. Instead, it focuses on companies with strong free cash flow, consistent profitability, healthy balance sheets, and a history of paying dividends and paying growing dividends. In other words, SCHD tries to own quality businesses first and dividend payers second. That's an important distinction. The makeup is not to chase yield alone, because investors that do that often find out a tough lesson. Looking here at this chart, we can see that the ETF has climbed nearly 50% over the past 5 years, averaging a perfect 10% per year. And currently, the ETF has assets under management of $95 billion. And we just finally snapped a 9-week positive winning streak for the NASDAQ. Look at this chart right here, looking at the VanEck Semiconductor ETF, SMH, which is up an incredible 50% since the start of April alone, which is just unprecedented. These are great times to be an investor, but at the same time, when we see runs like this, we can't just be buying blindly and need to ensure we are doing proper due diligence. It's more important now than ever. And one of my favorite tools to research stocks and ETFs is the use of investing.com, the world's leading financial information website. It offers a free all-in-one hub for global financial news covering US stocks and more. I'm currently an Investing Pro member, which is their flagship program. In fact, the charts you just saw came from Investing Pro. And I also love to use their Pro Picks AI feature, which helps me find new stock ideas. There's a number of different strategies that can fit any type of investor needs, and the strategies are updated on a monthly or quarterly basis with the help of AI. For example, here you can see the Tech Titans for investors who are looking for growth and technology-focused ideas. Another great one is Buffett's Picks, which follows his stock picking criteria, and you can see the performance for yourself. And the best part is the fact that they are running a special summer sale promotion right now for a limited time that will get you 55% off their subscriptions. But that's not all. When you use my link in the description below, you will get an additional 15% on top of that. This is a limited time sale you don't want to miss. So make sure you use my link down below and give Investing Pro a try today. So now let's get back to the video talking about why some investors have been ignoring SCHD. And in 2026, again, it's been all about technology, growth, AI, and such. But when we compare the S&P 500 to SCHD, it's probably not much of a contest, right? Wrong. Look here at this chart from Investing Pro. We can see that, surprisingly to some, SCHD, which is notoriously light when it comes to technology exposure, is actually outperforming the S&P 500 by a pretty good margin, 19.5% to 11% year to date. Looking here, you can see the sector breakdown when it comes to SCHD. Top sector being healthcare, accounting for nearly 19%, followed then by consumer staples, then technology at 16%, followed then by energy and financials rounding out the top 5. Technology having a top 3 sector weighting is definitely unlike SCHD, but also a reason I like it a lot in 2026. It's not your traditional high-flying technology stocks. Here's a look at some of those top holdings within the ETF. Starting with the top 2 positions, which are both technology stocks in Qualcomm and Texas Instruments, followed then by United Health, Coca-Cola, Merck, Chevron, Verizon, Procter & Gamble, ConocoPhillips, and Amgen. The top 10 stocks account for roughly 40% of the entire ETF. I said it when I did the reconstitution video, and I will re-emphasize the same thought here again today. I love the new makeup of SCHD in 2026. Qualcomm, I mentioned, being a great buy low candidate at the time, and now it has led the charge for the company much in the way Broadcom did a few years ago. And I shouldn't say the company, I should say the ETF. I also like the buy low candidate of United Health and Merck as well, both in fact outpacing the S&P 500 in their own right. And now you're getting a great value on Procter & Gamble. But this is what I love about SCHD and why I invest in it so heavily already. It's because SCHD has relatively limited exposure to many of those markets' hottest names. And even though technology has become a larger stake, it's not the Microns, Nvidias, SanDisk, Marvells that are found inside SCHD. As a result, many investors sometimes view SCHD as boring, but markets move in cycles, and that's where things are starting to get interesting. So why is now the time to start buying more SCHD, you might ask? Well, there's several reasons, in fact. First, valuations. Many of the market's favorite growth stocks have seen tremendous multiple expansion. That doesn't mean they're bad investments, but expectations have become very high. SCHD, meanwhile, is filled with companies trading at much more reasonable valuations. Second is going to be dividend growth. Many of SCHD's holdings continue increasing their dividends year in and year out. That's a powerful way to combat inflation over long periods of time. Looking here, we can show you the ETF's current dividend yield is sitting at 3.2%, and they have a growing dividend for 15 consecutive years and a 5-year dividend growth rate that sits right around 10%. It's just a great combination of three key things. First being growth potential, share price appreciation. We just saw the ETF is actually outperforming the S&P 500. It doesn't do that every year, but there are a lot of times it does. And it does a good job of holding its own regardless of what's going on in the market. Another reason as it pertains to the dividend is the yield. Having growth and a high yield is not something you find very often. Over a 3% yield combined with that growth is fantastic. And the third element of the dividend is the dividend growth. Dividend growth around 10% is the cherry on top. This is an investor's trifecta, and it puts the power of compounding into overdrive. Far too often, investors focus way too much on yield, but not me. I prefer much more focus on dividend growth. And on top of that, most dividend growth companies also offer solid share price appreciation as well. So the third reason to own SCHD is just simply quality. SCHD owns businesses that generate real cash flow. If they don't, they can't pay dividends. And these companies don't only pay dividends, they pay growing dividends year in and year out. Here are the 5-year dividend growth rates for the top 10 positions in the ETF. Qualcomm is at 7%, Texas Instruments at 8%, United Health at 12%, Coca-Cola at 5%, Merck at 7%, Chevron 6%, Verizon 3%, Procter & Gamble 6%, and the largest of the top 10 is ConocoPhillips at 14% 5-year dividend growth rate, then followed by Amgen at 8%. In uncertain markets, that can matter more than investors realize. This, in fact, is one of the biggest reasons, and you often hear me say that SCHD is, in fact, the best complement to a tech-heavy portfolio, a growth-heavy portfolio, and that includes the S&P 500 these days. This balances out your portfolio in so many ways, holding it in times of growth and outperforming in weak times as well. And this is why SCHD is a top 10 position in my portfolio. And if you want to see all of my holdings, get trade alerts anytime I buy or sell a stock, get my weekly market reports, then join my investing community, the Stock Investor's Edge. There's a link down in the description below. And that's going to bring me to the current situation we're at with the stock market right now, the summer swoon. One reason SCHD becomes more interesting to me right now is the market environment. We have seen strong rallies, rising valuations, growing optimism, but lower cash levels as well. Seemingly everything that's been going right for the markets, regardless of the headwinds. High oil prices? No problem. Sticky inflation? No problem. Continuation of the war? No problem. However, the strongest bull markets in the past always go through pullbacks. They ensure the run is lasting, and in fact, it's healthy for a sustained run to have a pullback. And if we experience a full-fledged correction or even a period of consolidation, investors may start rotating back towards quality and income-producing assets like SCHD. Historically, those environments have often been friendlier to dividend-focused strategies. I'm not saying a correction is guaranteed. I'm just saying investors should be prepared for multiple outcomes. Now let's answer the big question. Should everyone buy SCHD heavily? No. If you're 25 years old, aggressively pursuing growth, comfortable with volatility, you may prefer a heavier allocation to growth-oriented investments. But if you're building long-term generational wealth, seeking growing income, looking for quality businesses, trying to reduce portfolio volatility, then SCHD deserves serious consideration. But again, both types of investors can have exposure. The question, though, is not whether it should be a holding, but rather how big of a holding. So what is my take? My answer is it is in fact becoming more attractive. Not because it's exciting, not because it's trendy, but because it provides exposure to quality companies, dividend growth, reasonable valuations, and strong cash flow generation. And sometimes the best investments aren't the ones everyone is talking about. They're the ones investors have temporarily forgotten. That may be where SCHD sits today. And as always, it provides balance to any growth or tech-focused portfolio. And many positions inside the top 10 offer some quality upside. And any dip below that $30 level, I would definitely be buying up more SCHD. So this is my update on SCHD. And if you enjoyed the video, as always, do me a huge favor, smash that like button down below, subscribe to the channel, and be sure to take advantage of that limited time sale for Investing Pro using the link in the pinned comment below. And let me know in the comments whether you rate SCHD a buy or not. Thanks again for watching, and we'll see you in the next one. Take care.